In the spring of 1884, prices on the New York Stock Exchange began to move days before any public announcement was made. No laws were broken, no contracts violated, yet a small group acted first, and everyone else paid the price. Something had already been decided. This video examines how the New York Stock Exchange was quietly steered in 1884, and why a series of concentrated railroad stock purchases recorded before any corporate disclosure suggests the market was guided by advanced knowledge. The verdict is direct. The system worked exactly as designed, even if the outcome was never meant to be seen. By the early 1880s, the American financial system was entering what newspapers of the time described as an age of confidence. Railroads stretched across the continent, industrial output expanded at unprecedented speed, and the New York Stock Exchange had become the unquestioned center of capital allocation. Publicly, the market presented itself as orderly, competitive, and increasingly modern. Privately, it relied on customs that were older, quieter, and far less visible. In 1884, the year would later be remembered for a sudden break in railroad stocks that shocked investors across the country. What is less remembered is what happened in the weeks before that break. Trading ledgers from the period show clusters of purchases executed by the same houses on the same securities within narrow windows of time. These moves occurred before earnings statements were released, before dividend adjustments were announced, and before the press had any indication that conditions were about to change. At the time, this raised few public questions. There was no legal requirement for companies to disclose financial stress in advance, no formal prohibition against acting on non-public information, and no regulatory body tasked with defining fairness in markets. Information flowed unevenly by design. Those closest to boards, rail lines, and credit networks learned first. Others learned later, often from the price itself. The financial press of the era played a careful role in maintaining the market's image. Newspapers reported volatility after it occurred, rarely before. Editorials framed losses as misjudgments by the inexperienced, reinforcing the idea that success was a matter of insight rather than access. Reputation mattered deeply, and so did discretion. To suggest that the market could be guided without fraud risked undermining confidence in the very institutions that sustained it. For small investors, the consequences were immediate and measurable. By the time public notices appeared and rumors reached the street, prices had already shifted. Capital moved upward, not through deception, but through timing. The losses were real, even if the mechanism behind them remained invisible. No courtroom would hear these cases because no statute had been violated. What emerges from this period is not a story of criminal conspiracy, but of structural advantage. The rules that existed did not prevent manipulation. They simply failed to name it. Market outcomes were shaped by decisions made in advance, executed quietly, and justified afterward as the natural order of finance. This gap between public image and private operation became a defining feature of the Gilded Age economy. The risk, then, was not only financial, it was institutional. Each time the market moved without explanation, trust was transferred away from the many and concentrated among the few. Each silent success reinforced a system in which legality and morality no longer shared the same boundary. And because nothing illegal had occurred, nothing needed to be corrected, at least not yet. If this raises a question about which ledger, file, or archived record first reveals that advanced knowledge, consider leaving a comment and subscribe so you don't miss the next document we uncover. And if this investigation holds your attention, a quiet like helps keep it visible. By the end of the decade, these practices would no longer be isolated events, but normalized behavior, embedded in how markets functioned and how fortunes were preserved. What began as an advantage became a method, and what was once informal would eventually demand a name. The story starts here, in the margins of trading books, where a date was written down before the public ever knew it mattered. Between 1870 and 1890, the American financial system operated inside a legal environment that was not merely underdeveloped, but intentionally permissive. This was not a transitional flaw waiting to be corrected. It was a framework shaped by custom, reputation, and private agreement rather than statute. At the center of this arrangement stood institutions like the New York Clearinghouse, whose authority was immense but informal, and whose decisions shaped liquidity, credibility, and survival without ever being framed as regulation. In that period, there was no standardized requirement for corporate disclosure. Railroads, industrial trusts, and large banking houses were under no obligation to publish balance sheets on fixed schedules, to announce operational setbacks, or to warn investors of impending strain. Financial information was treated as proprietary by default. What the public learned, it learned late, often through the movement of prices rather than through any formal communication. This asymmetry was not hidden. It was accepted as a natural condition of serious finance. The press reinforced this structure. Newspapers reported on outcomes, not on processes. A collapse would be explained after the fact, framed as the result of market temperament, seasonal pressure, or overextension by smaller players. The idea that access itself could be the decisive advantage was rarely stated outright. To do so would have challenged the reputations of institutions whose credibility depended on appearing neutral, even as they operated within tightly controlled circles. The New York Clearinghouse played a decisive role in stabilizing this environment. Formed as a private association of banks, it coordinated responses to stress through mutual agreements rather than public mandates. In moments of pressure, it could extend or withhold support, signal confidence, or quietly allow a member to fail. These actions were concrete and consequential, yet they left little in the way of accessible records. Decisions were logged internally, communicated selectively, and justified as prudential rather than strategic. Crucially, there was no legal concept corresponding to what would later be called insider trading. Acting on non-public information was not categorized as misconduct. It was understood as diligence. Directors, major shareholders, and aligned financiers were expected to know more than the public and to act accordingly. The law did not merely fail to prevent this behavior, it did not recognize it as a problem. Advantage was indistinguishable from competence. The consequence of this structure was measurable. Capital accumulated upward, consolidating around those with institutional proximity. Losses, by contrast, were distributed outward, absorbed by individuals who entered positions after prices had already adjusted. When these investors failed, their failures were interpreted as personal misjudgments, not as symptoms of an uneven system. There was no mechanism for redress because no violation could be identified. This arrangement carried risk, but not the kind that concerned lawmakers at the time. The danger was not that the market would be exposed as unfair, but that confidence might erode if the appearance of order collapsed. Reputation functioned as a form of currency. Maintaining it required silence, discretion, and a shared understanding of what was not to be discussed openly. The boundary between public trust and private knowledge was carefully managed. By the late 1880s, this environment had normalized a specific pattern of behavior. Information moved first through private channels, then through prices, and only last through public explanation. Each repetition reinforced the legitimacy of the process. What began as custom hardened into expectation. The absence of written rules did not create chaos. It created predictability for those positioned correctly. This is the context in which the movements of 1884 must be understood. A market governed not by transparency, but by proximity, not by deception, but by omission. The system did not malfunction. It performed within its accepted limits, and because those limits were never codified, they were never questioned. The surviving records from this period reflect that logic. Balance sheets appear late, announcements are delayed, transactions cluster without explanation, nothing is falsified, yet nothing is clarified. The paper trail is intact, but incomplete by design. What follows is not an accusation, but a sequence. Within this structure, a decision could be made without being recorded as such. And once that decision was acted upon, the market would move as if on its own, leaving behind only numbers, dates, and the quiet certainty that someone, somewhere, had known first. By 1887, the pattern was no longer confined to a few suspicious clusters in the railroad tape. It had matured into something quieter and more dependable, a market in which certain men did not predict outcomes so much as receive them early, in a form the public would never see. If 1884 showed that prices could move ahead of explanation, 1887 shows who benefited from that timing and why their advantage was not accidental. Jay Gould sits at the center of this period, not because he was the only actor capable of it, but because his position made the mechanism visible. He was not merely trading around railroads, he was embedded in them. He had access to operating realities, traffic, earnings pressure, rate disputes, rolling stock constraints, before those details were converted into the sanitized language that investors were allowed to read. In an era when there was no standardized disclosure calendar and no recognized offense for trading on private knowledge, this access did not require concealment. It required proximity, and Gould had it in abundance. The channel that carried this advantage was not rumor, it was paperwork and wires. Railroads ran on telegraph lines as much as they ran on steel, and the telegraph did not only transmit schedules and emergencies, it transmitted confidence. Short notes, operational summaries, and private directives moved between offices and intermediaries at a speed that newspapers could not match. In 1887, financial letters still carried weight, but telegrams carried timing. A week of weakening freight receipts did not need to be announced to affect a price if it was already known, quietly, by the small circle that mattered. What survives in the record is rarely a single dramatic proof. Instead, it is the mismatch between when information should have become knowable and when the market behaved as if it already was. In multiple instances across that year, railroad shares showed concentrated buying or selling pressure before any public statement could plausibly explain it. Brokerage houses that served the same clientele appeared on the same side of trades within narrow windows. The tape moved first. The explanation arrived later. For the investor outside the circle, the first true notice of a change in fundamentals was the price itself. This is where the question of who knew before becomes less abstract and more social. The beneficiaries were not anonymous geniuses scattered across the city. They were attached to institutions, to boards, to social rooms where reputations were defended and where information was treated as a form of property. The New York Clearing House, the major trust companies, and the railway offices themselves created a layered world of access. Inside that world, a man did not need to invent a story to make money. He needed to receive the real one before it was recast for the public. The concrete action in 1887 is not hard to describe because it was administrative and ordinary. Information was withheld from the general market while it circulated privately. A notice could be delayed. A letter to shareholders could be drafted but not released. A report could be summarized for a board and never printed for investors. Nothing had to be forged. Nothing had to be falsified. The Dias act that mattered was a mission, holding back a detail that would move confidence until the right positions were already taken. In the surviving business correspondence of the era, this often appears as a gap rather than a statement. A known strain discussed inside a network, followed by a public silence that lasts just long enough for the tape to adjust. The consequence of that omission was not merely a clever trade, it was a predictable transfer of wealth. The buyers who entered early gained the upward move when positive news finally surfaced. The sellers who exited early avoided the collapse when the market eventually absorbed negative realities. Those who entered on the public signal, after the press had framed the move, after the exchange chatter had turned into news, took the other side of a trade already decided. Their losses were real, and their confusion was treated as a personal failure to understand the market, rather than a structural disadvantage built into how the market received information. This was the public-facing language of the era. Success belonged to the informed, and the uninformed should not have participated. That logic protected the reputations of the men who benefited most. It also protected the institutions that depended on confidence. A fully transparent admission, yes, certain groups learned first and acted first, would have risked turning volatility into scandal. Instead, the press described movements as temperament, cycles, and overreach. The market was always said to be responding, never being guided. The distinction matters because it explains why Gould and men like him could operate without fear of legal consequence. The Interstate Commerce Act was passed in 1887, and it is often remembered as a sign that the country was beginning to confront railroad power. But that confrontation was aimed at rates and discrimination in commerce, not at the informational structure of Wall Street. The Act did not establish a principle that private operational knowledge must be shared with investors. It did not define the market as a place where equal access was required. The legal system was beginning to name certain abuses, but it had not yet named this one. In that gap, timing remained a legitimate asset, and Gould's advantage was not simply that he had information, it was that he sat at the crossroads where information became actionable. Operational decisions could be translated into trades long before they became headlines. A change in dividend policy, a strain in short-term financing, a rate dispute, a quiet adjustment in expansion plans, these were not theoretical possibilities to him. They were the practical texture of control. That is why the market's movement could look uncanny to outsiders. They were observing the shadow of a decision they were never invited to witness. The beneficiaries extended beyond a single individual. They included aligned banking houses, friendly brokers, and the social architecture of the Gilded Age itself. Clubs, boardrooms, private dinners, where business and reputation were negotiated in the same breath. Old money did not always need to conspire in the dramatic sense. It needed to coordinate expectations and protect discretion. When information moved through that world, it arrived carrying the weight of trust. A telegram's value was not only its content, but its source. The men who gained were the men whose sources were unimpeachable inside the circle and irrelevant outside it. This is why the paper trail feels both present and elusive. The market's movements are visible in prices. The proximity networks are visible in names, positions, and institutional ties. The missing piece is always the same, the moment when a detail is intentionally held back from the public channel while it remains active inside the private one. That missing moment is not an accident of history. It is the product of a culture that treated disclosure as a privilege, not a duty. By the end of 1887, the investigation advances in a way that is difficult to ignore. The advantage was not luck. It was not superior analysis. It was position. position within the railroads, within the financial houses, and within the reputational systems that decided what could be said publicly and what would remain confined to the circle. The market did not need to be broken to be controlled. It only needed time to be rationed. And that brings us to what happens next. Once you can identify who benefits from silence, the next question becomes administrative rather than moral. When the moment arrives, who chooses to delay the public notice? And how is that delay justified inside an institution that claims neutrality? The answer does not begin with a courtroom. It begins with a decision that can be written down without ever sounding like a decision at all, on a dated directive, folded into correspondence and sent by wire. In 1890, the Erie Railroad did not need a falsified report to move money from one set of hands to another. It only needed time. The company sat inside a familiar Gilded Age bind. Operating pressures were real, credit conditions were tightening, and the market's confidence depended less on truth than on the order in which truth arrived. On paper, Erie was still a functioning railroad with routes, rolling stock, and cash receipts. In practice, its financial position was exposed to a single vulnerability that mattered more than the numbers themselves. What would happen to its price if the numbers were allowed to speak at the wrong moment? What makes 1890 different from the earlier years is that the mechanism becomes less social and more administrative. In 1887, the advantage traveled through private telegrams and letters, and the market's behavior looked like a pattern of proximity. In 1890, the decisive event is a choice made inside an organization, an ordinary internal act that carries no dramatic language and no legal risk, yet alters the market's sequence of knowledge. The decision is not a scheme in the theatrical sense. It is a delay, a postponement, a controlled release schedule justified as prudence. The Erie Railroad's leadership had wide latitude to manage disclosure simply because there was no standardized disclosure regime to violate. There was no SEC, no mandatory quarterly reporting rhythm, no enforcement framework that assumed equal access. Companies issued statements when they chose, in the format they chose, with the timing they chose. The financial press might complain about uncertainty, but uncertainty was not a breach. It was a condition of the era, and for large institutions it was often useful. The surviving record from 1890 does not read like a confession. It reads like routine administration, references to consolidation, to auditors, to pending negotiations, to the need for complete figures before public release. Those phrases appear harmless until one watches what happens around them. When information is delayed in a market built on uneven access, delay is not neutral. It becomes a tradable asset. The difference between releasing a weak statement today or in 2 weeks is not merely the difference between two dates. It is the difference between who has time to reposition and who is forced to react. On October 27, 1890, as financial conditions in New York grew more sensitive and international credit tremors were increasingly discussed in banking circles, Erie's internal posture was not that of a company preparing the public for stress. It was the posture of a company protecting the sequence of disclosure. The formal rationale could be written without scandal. Figures were being finalized. Negotiations were ongoing. The statement would be issued once properly arranged. In practice, what mattered was that the negative material, any shortfall, any deterioration, any unfavorable debt pressure, was held inside a small administrative perimeter while the market outside continued to trade under a public illusion of normal timing. This is where the decision becomes visible in concrete terms. A negative announcement is not made when it first becomes known internally. It is deferred. The act is omission, and the mechanism is scheduling. The company does not invent a false profit. It withholds an unfavorable development until a more convenient window. That window may align with a refinancing step, acquired credit accommodation, or simply the time required for aligned interests to reduce exposure. The market, deprived of the information, is not deceived in the legal sense. It is merely left uninformed until the moment when being uninformed becomes financially expensive. Inside Erie's orbit, the privileged side of the market does not need to be told that a statement has been postponed. It only needs to observe the internal temperature through the same networks that always existed in the Gilded Age. Directors, major holders, banking relationships, and the brokerages that serve them. The action is not public, but it leaves traces. Trading patterns shift before the press has anything meaningful to report. The tape begins to show a change in posture that the public cannot rationally explain. This is the moment where a decision made in an office becomes a market movement that appears spontaneous to everyone else. The significance is not that insiders heard a rumor. It is that the timing of disclosure itself was managed as if it were a lever. In a modern framework, the decision to delay material news would draw scrutiny. In 1890, it could be defended as corporate housekeeping. That is why the Act carries such power. It sits in the space between legality and fairness, where reputations could be protected without paperwork ever admitting what was being protected. The choice could be framed as responsible governance, while its effect functioned as a selective warning signal delivered only to those positioned to receive it. Once that delay exists, insiders gain a clean operational advantage. They can lighten positions quietly, shift holdings through friendly channels, or take the other side of the eventual public reaction. This does not require a dramatic sell-off. It often looks like a measured redistribution, exposure reduced here, cash raised there, a gradual repositioning that avoids drawing attention. The public sees no crisis because the public has not been officially told there is a reason to see one, and that absence, silent, procedural, defensible, becomes the condition that allows wealth to move without friction. The consequence is not theoretical. When the unfavorable information finally arrives through a delayed statement, a belated notice, or a public acknowledgement that financial pressure exists, the market reacts in a way that appears sudden. The public side experiences a break, prices adjust sharply, confidence drops, and small investors who believed they were participating in a fair contest discover that the contest ended before they knew it had begun. Their losses are not a moral lesson. They are a mechanical outcome of delayed knowledge. Capital does not vanish. It changes ownership. The insiders who acted early are not necessarily winners in a celebratory sense, but they are positioned to avoid harm and, in many cases, to profit from the adjustment that others must endure. What protects the decision is the era's obsession with reputation and inheritance. In the Gilded Age, corporate standing was not only an economic matter, it was a social one. A railroad's credibility touched banks, families, trusteeships, and the perceived stability of entire networks of wealth. Admitting early weakness risked more than a lower price. It risked a press cycle, a whisper campaign in financial rooms, a loss of favorable credit terms, and a stain on the institutional image that could outlast the quarter. Delay, by contrast, preserved the appearance of composure. It maintained the public posture long enough for the private adjustments to occur. The press played its assigned role. It could describe the move after it happened, not while it was being prepared. Market commentary would arrive framed as analysis, as hindsight, as a rationalization of volatility. The moral question, whether the public had been allowed to trade blind while others traded with foreknowledge, would remain largely unasked, because asking it threatened the architecture of confidence. The cost of Reputation was real, and silence was one of the few tools powerful enough to pay it. The conclusion of this block is narrow and deliberate. In 1890, the Erie Railroad's influence over the market did not come from a lie. It came from a choice about timing, an administrative act that delayed negative disclosure long enough for informed interests to reposition. The market reacted not to deception, but to the absence of timely disclosure. That absence was legal, and precisely because it was legal, it could be repeated without fear. By the time the public narrative caught up, the private narrative had already concluded. The trades were placed, exposure was shifted, and the price movement had done its work. What remains, when you look for it, is rarely a dramatic memo. It is a small, concrete artifact of postponement, a dated internal notation, a deferred release, a file held back until complete, sitting in a paper trail that never needed to call itself a strategy. And once such a delay exists as a usable tool, the next step is inevitable. Groups who understand the timing advantage begin to coordinate around it, turning silence into structure and structure into something that resembles a pool. In 1882, Northern Pacific Railway was not merely a railroad project moving westward on paper. It was a financing machine whose credibility depended on a delicate balance between perception and cash. The public saw track, land grants, and a symbol of national expansion. The market saw something narrower, a security whose price could be stabilized, lifted, or broken, depending on who controlled the available shares and who controlled the short-term credit that allowed trading to continue. The change that matters in this year is not a change in statute or in published policy. It is a change in how the market's supply and liquidity were managed, quietly, deliberately, and with no falsification required. A stock pool was not a theatrical conspiracy. It was an arrangement that altered the practical conditions of trading. It worked because the exchange did not operate as a transparent arena with equal access. It operated as a venue where a limited group of houses could coordinate behavior through private agreement while the broader public saw only the tape. In the record, the pool often appears as an absence. There is no public filing titled pool. There is no announcement that a float has been gathered and locked away. What appears instead are clustered transactions, repeated counterparties, and a narrowing of available supply that becomes visible only through price behavior and settlement stress. Northern Pacific's stock, in that period, could be both widely discussed and thinly available in the hands that mattered. The project drew attention, but attention did not equate to free supply. Large blocks could sit inside trust arrangements, banking relationships, or friendly nominee holdings. That is the first alteration. The tradable float could be reduced. Without any formal notice to the market, shares did not need to disappear in a literal sense. They only needed to be removed from circulation. In 1882, that removal could be as simple as transferring stock into aligned accounts under names that did not attract attention, then refusing to lend those shares into the market when demand increased. It was not a lie. It was a change in availability. Once a tradable float is tightened, price becomes less a reflection of public consensus and more a reflection of controlled scarcity. This is where coordinated buying matters. A pool does not buy randomly. It buys with timing. Purchases arrive in the same security through multiple houses, not to conceal activity from the exchange, but to distribute it across familiar channels, so it reads like ordinary interest. In the settlement record, this presents as repeated buying pressure that does not fully reverse when the public is tempted to take profits. The market senses a strong hand without being able to name it. That perception becomes fuel. Outsiders follow, believing they are participating in momentum, when in fact they are stepping into a managed environment. The second alteration is liquidity, and in the Gilded Age, this was the sharper instrument. Trading did not simply depend on willingness, it depended on credit. Margin accounts, call loans, and short-term accommodations allowed positions to exist. In 1882, when a pool tightened float and then influenced credit conditions directly or indirectly, the market could be moved with a precision that looked to outsiders like natural volatility. A pool did not need to fabricate earnings. It could raise the price by restricting supply, then intensify the move by ensuring credit remained available long enough for the public to enter, and finally reverse the conditions by withdrawing liquidity at a chosen moment. The act of withdrawal did not require a public declaration. It could occur as a series of private instructions, loans called, credit lines reduced, collateral demands tightened. This could be done within the ordinary vocabulary of prudence. A bank or house could cite risk management. A lender could claim changed conditions. The result was the same. Traders who relied on short-term credit were forced to liquidate positions into a market whose supply had been constrained and whose direction had been guided. The pool did not need to sell aggressively to create a break. It only needed to let the market's leveraged participants collapse under their own financing structure at the moment liquidity was rationed. The consequence of these alterations was a familiar sequence, an artificial rise followed by a predictable collapse. The rise did not look artificial while it was occurring. It looked like confidence. It looked like the public discovering a good story at the same time. That was the point. When the collapse came, it could be explained as a correction, an overreaction, a shift in sentiment, anything except what it actually was, a market environment that had been quietly changed in advance. The public was not deceived by a false statement. It was exposed to altered conditions without being told the conditions had changed. This is the critical distinction that preserved legality. No contract had to be violated because contracts did not require equal informational timing. No fraudulent representation had to be made because the mechanism relied on what was withheld and what was unavailable, not on what was falsely asserted. The market was run by managing the order of knowledge and the availability of capital. In that world, a pool was less an act of persuasion than an act of engineering. The press, when it spoke of such moves, rarely used language that implied coordination. In 1882, financial reporting often described support in a stock, or strong buying, or unexpected firmness, without interrogating the source. Newspapers and weeklies could hint at interests in a security, but the tone remained careful. Naming names could invite retaliation, cut off access, or damage relationships with the same institutions that supplied commentary and advertising. Reputation in that environment functioned as a gate. The public received narratives that protected confidence because confidence protected the system. Northern Pacific, as an entity, benefited from this environment in a narrow but important way. A stable or rising stock price could support financing, improve standing, and ease negotiations. That does not mean the company ran the pool in an official sense. The point is more structural. The line between corporate financing and market behavior was porous, and private networks bridged it. When a major railroad securities became the focus of coordinated activity, the activity was often framed as market interest, not as a managed condition. That framing allowed the mechanism to persist without legal consequence because the law did not define the behavior as wrongdoing. The effect on smaller investors was direct. They arrived when the story became public, when the movement looked validated by the tape, and when entry felt rational. They bought into a price shaped by scarcity and supported by credit conditions they did not control. When liquidity tightened, they experienced the reversal as sudden and personal. They could not point to a false statement because none was required. They could not claim breach of contract because their contracts did not guarantee fairness, only execution. Losses, therefore, remained private, while the mechanism remained institutional. What survives of the pool's existence is rarely a single document titled as such. It is the indirect record of altered supply and altered credit. It is the pattern of coordinated accumulation, the unusually persistent bid, the narrowing float, and then the abrupt stress when call money tightens and forced selling begins. It is also occasionally the administrative residue, transfer entries into nominee names, collateral substitutions, margin calls that arrive in clusters, and settlement notes that reveal pressure without ever stating intent. By the end of this block, the investigation advances in a practical way. We no longer have to rely on moral language to understand how a legal manipulation could function. The mechanism is mechanical: reduce the float, coordinate buying, maintain credit long enough for the public to enter, then withdraw liquidity quickly enough that leveraged participants must liquidate into the break. The market does not need to be lied to. It only needs to be placed inside conditions it cannot see. This is why the outcome was predictable and repeatable. Once the technique exists, the market begins to respond to it as if it were weather. Traders learn to fear sudden tightening. Newspapers learn to describe collapses as conditions. Institutions learn that silence is safer than explanation. And as soon as credit itself becomes the lever, the next step becomes inevitable. A day arrives when the market obeys not because it is persuaded, but because liquidity is pulled in a coordinated way, leaving the public to read the decision only from the damage. The last image is not dramatic, but it is concrete. A transfer ledger showing a block of Northern Pacific shares moved into a nominee account, followed days later by a margin call stamped and dated, and the tape in between, rising cleanly until the credit is recalled. On May 9, 1893, the market did not collapse because a secret was revealed. It contracted because something ordinary was removed. The action that mattered that day was not a speech, not a filing, and not a public announcement. It was the coordinated withdrawal of short-term credit, executed quietly through institutions whose authority was already accepted as stabilizing rather than coercive. When liquidity disappeared, the market obeyed, not out of fear, but out of necessity. By the spring of 1893, pressure had been building across the financial system. Railroad revenues were uneven, international capital flows were tightening, and confidence rested on a fragile network of call loans that allowed positions to remain open from day to day. These loans were not exotic instruments. They were the daily bloodstream of the market, renewed routinely and recalled when conditions changed. Their power lay in how quickly they could be altered without explanation, and in whose hands the authority to alter them rested. At the center of this network stood J.P. Morgan & Co., not as a conspiratorial force, but as a coordinating one. The firm's relationships with banks, trust companies, and clearing mechanisms meant that its posture toward credit signaled more than opinion. It shaped behavior. When Morgan-aligned institutions began to reduce exposure and call in loans, the action did not read as aggression. It read as prudence. That distinction mattered because prudence carried legitimacy, and legitimacy allowed a systemic change to occur without resistance. The concrete act on May 9th was administrative. Call money that had been routinely rolled was reclassified as risk. Renewal became conditional. Collateral requirements tightened. Lines that traders assumed would be available were suddenly not. None of this violated a statute. No agreement guaranteed indefinite credit. The change could be defended in the language of responsibility. Conditions had shifted, and credit had to reflect that reality. Yet the timing of the shift transformed it from a response into a trigger. Once short-term credit contracted, the market's mechanics did the rest. Leverage positions could not be maintained without funding. Forced selling began not because investors had changed their minds, but because they had lost the means to wait. Securities were liquidated into falling prices, accelerating declines that fed back into further calls for margin. What looked, from the outside, like panic was in fact a sequence of obligations being enforced all at once. The immediate effect was a freeze. Transactions slowed, bids evaporated, and confidence, so carefully preserved through silence, vanished in hours. This was the opening phase of what would be remembered as the Panic of 1893. But on that day, it did not announce itself as a crisis. It presented as a tightening, a rational adjustment. Only later would its systemic nature become undeniable. The risk embedded in this execution was profound, and it is essential to understand why it was tolerated. Credit withdrawal on this scale exposed not only speculators but institutions, municipalities and railroads whose financing depended on rolling obligations. If the mechanism were named as deliberate coordination, it would invite scrutiny into the private authority of those who controlled liquidity. That scrutiny threatened reputations that extended far beyond the market, into politics, philanthropy, and the inherited standing of elite families. Silence, once again, was cheaper than explanation. What makes May 9th, 1893 distinct is not that credit had never been withdrawn before, but that the withdrawal was synchronized across enough of the system to override individual resistance. A single lender calling loans could be replaced. A network acting in alignment could not. The market did not negotiate with this action. It adjusted to it. Prices fell because there was no alternative. The legality of the act shielded it from immediate challenge. Call loans were callable. Risk assessments were discretionary. No document recorded a collective decision because no such document was required. Each institution could point to its own balance sheet and defend its own choice. Yet the effect was collective, and its timing was not random. The market moved as if responding to a command, even though no command had been issued. For small investors, the consequence was swift and unforgiving. Positions that appeared sound days earlier became untenable overnight. Losses crystallized not because fundamentals had suddenly changed, but because the ability to hold through uncertainty had been removed. Wealth shifted toward those who had reduced exposure in advance or who had the reserves to withstand the contraction. This redistribution occurred without accusation because it occurred through enforcement of existing terms rather than violation of them. The press struggled to keep pace. Reports described stringency and nervousness, careful not to imply orchestration. To suggest that the market had been made to obey would raise questions about who held that power and why it was unchecked. Instead, the narrative emphasized inevitability, framing the crisis as the natural result of overextension rather than the consequence of a timed withdrawal. The risk, had the coordination been openly acknowledged, would have been structural. Confidence in the neutrality of credit would have fractured. Alliances between banks, railroads, and financiers would have been exposed as instruments of control rather than stability. The market's image as an arena of independent judgment would have collapsed alongside prices. That risk explains why the execution remained undocumented as a collective act, even as its effects were unmistakable. By the end of that week, the damage was visible in closed firms, suspended railroads, and communities whose savings were tied to securities that could no longer find support. The system had not broken a rule, it had revealed one. Liquidity was not a background condition, it was the lever, and those who controlled it could, when aligned, dictate the market's movement without ever speaking publicly. The bloc resolves its tension here, not with outrage, but with clarity. On May 9, 1893, the market obeyed because the terms of participation were altered in real time. Credit was recalled, liquidity froze, and a crisis began without a single illegal act. The next question, unavoidable once this is understood, is not how the market fell, but who stood positioned to endure or profit from the fall, while others were forced out by a mechanism they were never told could be pulled. Between 1893 and 1894, the consequences of the market's obedience were no longer abstract. They were spatial, visible, and unevenly distributed. In Lower Manhattan, the effects of the credit contraction and forced liquidation settled not as a single event, but as a sequence of small, irreversible decisions made by people who arrived late to a market that had already moved on without them. The first concrete action was not institutional, it was individual. Investors who had entered positions during the final weeks of apparent stability began to sell, not as a strategy, but as a response to margin calls, evaporating bids, and the sudden realization that waiting was no longer an option. These sales were not coordinated, they were reactive. Shares were offered into a market whose liquidity had already been withdrawn, turning ordinary exits into losses that compounded with each hour. What appeared in newspapers as panic was, in practice, a forced unwind driven by financing terms that had changed after positions were established. The geography of the damage mattered. Lower Manhattan concentrated brokerage offices, trust companies, and the physical points of access through which ordinary investors interacted with the market. Clerks, small merchants, professionals, and retirees who had allocated savings into railroad and industrial securities did so through these channels, believing they were participating in the same system as everyone else. When prices began to fall, they returned to those offices to sell, only to discover that bids were thin, terms were worse, and time had become an adversary rather than a resource. The consequence of these panic sales was not merely loss, but displacement. Securities moved out of public hands and into accounts that could hold them without immediate financing pressure. Institutions and families with reserves, those who had reduced exposure earlier or who could meet tightened collateral demands, absorbed the flow. This was not charity. It was arithmetic. Assets sold under compulsion are acquired at discounts, and discounts favor those with patience and capital. As 1893 gave way to 1894, ownership of distressed securities consolidated upward, reinforcing the same networks that had been insulated from the initial shock. The social dimension of this transfer was rarely discussed directly, but it was recorded indirectly. Bankruptcy filings increased, savings were exhausted. Participation in the market narrowed as those who had suffered losses withdrew, not only financially but psychologically. The lesson absorbed by the public was not that the system was rigged in a dramatic sense. It was that participation carried risks that were unevenly borne. The market, which had been presented as an arena of opportunity, revealed itself as an environment where timing and financing determined survival. This concentration of loss outside the elite had institutional consequences. Trust in intermediaries eroded, not through scandal, but through quiet disengagement. Investors who had sold at the bottom did not return quickly, if at all. Their absence reduced liquidity on the public side of the market, increasing the relative influence of large holders and further stabilizing elite control. What began as a response to crisis hardened into a structural change. Fewer participants, larger positions, and a deeper dependence on institutional capital. Lower Manhattan became the stage where this imbalance was normalized. Offices reopened. Trading resumed. The visible signs of distress receded. But the composition of ownership had shifted. Securities that had once been widely held were now concentrated. The market's recovery, when it came, benefited those who had acquired during the forced liquidation, not those who had been forced to sell. Wealth did not vanish in the crisis. It relocated following the contours of credit and endurance. The press documented the human cost selectively. Stories of hardship appeared alongside assurances that stability would return, framing losses as the unfortunate outcome of speculation rather than as the predictable result of altered market conditions. This framing mattered. It preserved the legitimacy of the system by attributing failure to individual behavior rather than to structural design. The narrative allowed institutions to recover their standing without confronting the mechanisms that had concentrated loss. The inequality produced in these months was not incidental. It was a product of how the market functioned under stress. Those who arrived after prices had been guided upward, who relied on publicly visible signals, and who depended on rolling credit bore the brunt of the adjustment. Those who had acted earlier or who could withstand the contraction emerged with increased relative power. The gap between these groups widened, not through explicit exclusion, but through differential exposure to time and liquidity. By 1894, the pattern had repeated enough to become legible. Losses clustered among those without access to flexible financing. Gains accrued to those embedded in institutions capable of waiting. This outcome did not require collusion at the point of sale. It followed from the earlier decisions that governed disclosure, credit, and supply. The market's obedience had a social footprint, and that footprint traced the boundaries of class and access. The consequence for Lower Manhattan was a subtle transformation. The bustle returned, but the character changed. Transactions were fewer and larger. Public participation diminished. The market became less a shared space and more a managed environment, dominated by actors whose survival in the crisis had confirmed their authority. Inequality was no longer just an economic condition. It was an institutional fact, reinforced by recent memory. This bloc resolves its tension not with outrage, but with evidence of redistribution. The impact on those who arrived later was real, measurable, and durable. Panic selling was the visible action. Consolidation was the lasting result. The system did not correct itself after the crisis. It clarified itself. The final image is concrete and unadorned. A crowded brokerage floor in Lower Manhattan, slowly emptying as the day ends, clerks closing ledgers on accounts that will not be reopened, while across town, quiet transfers move the same securities into long-term holdings, setting the stage for what happens when such outcomes are repeated often enough to stop being questioned. In 1894, the public response finally acquired a formal address, but not a prosecutorial one. What had unfolded across the market now passed into an institutional setting, framed as inquiry rather than accusation. The United States Senate Committee on Interstate Commerce convened hearings that year amid rising pressure to explain how railroads, financiers, and credit networks had produced such widespread damage without any identifiable breach of law. The action was visible, recorded, and official. Its outcome was not. The hearings did not begin with the assumption of wrongdoing. They began with the assumption of disorder. Senators asked how railroads set rates, how capital moved, how credit was extended and withdrawn. and why the panic of 1893 had spread so quickly once it began. Witnesses were summoned, testimony was taken, and transcripts were printed. On the surface, the process resembled accountability. In substance, it operated as a boundary-setting exercise, an effort to determine what could be questioned without naming what could not. The concrete action of the committee was procedural. It held hearings. It received statements. It allowed evidence to be entered into the record. What it did not do was recommend indictments, propose criminal referrals, or draft immediate statutory remedies addressing market conduct itself. This was not an oversight. It was the consequence of a legal landscape in which the behaviors that had shaped the crisis did not correspond to any defined offense. The committee could ask how decisions were made, but it could not allege that those decisions were unlawful without inventing a category that did not yet exist. The limitation was explicit and, in its way, candid. There was no statutory basis for accusing financiers of acting on non-public information. There was no requirement that railroads disclose financial stress on a fixed schedule. There was no prohibition against coordinated credit withdrawal, so long as each institution could justify its actions individually. The committee could express concern, but concern did not translate into cause. Without a violation, there could be no charge. Without a charge, there could be no punishment. This produced a consequence that mattered more than any single verdict. By investigating without indicting, the hearings conferred indirect legitimacy on the methods they examined. Silence, delay, and coordination emerged not as abuses to be corrected, but as practices that fell outside the committee's reach. The absence of condemnation was not neutral. It signaled to the market that what had occurred was unfortunate, perhaps destabilizing, but ultimately acceptable within the existing order. The risk underlying this outcome was well understood by the participants, even if it was never stated openly. To redefine these practices as wrongdoing would have required more than legal creativity. It would have required confronting the role of elite institutions in managing confidence itself. The Senate committee operated in a world where the reputations of railroads, banks, and financiers were intertwined with national credibility. To accuse them of systemic manipulation would have invited a crisis of legitimacy, extending far beyond the market. Testimony reflected this constraint. Witnesses described conditions, not intentions. They spoke of pressures, not strategies. They emphasized complexity, not coordination. Language mattered. Words like prudence, custom, and judgment appeared frequently, while words like control or design did not. The record became a catalogue of plausible explanations that, taken together, explained everything and blamed nothing. The press followed. The same pattern. Coverage of the hearings emphasized inquiry and reform without assigning culpability. Headlines focused on the spectacle of testimony rather than on the structural implications of what was said. This framing reassured the public that something was being done while preserving the standing of the institutions most closely associated with the crisis. Accountability was implied through visibility, even as its substance remained elusive. The committee's restraint had a stabilizing effect, and that stability was itself a form of risk management. Markets depend on confidence not only in prices, but in the rules that govern participation. To retroactively criminalize conduct that had been customary would have undermined trust in the continuity of those rules. Investors, domestic and foreign, might have questioned whether any practice was safe from later redefinition. By declining to act decisively, the committee protected the predictability of the system at the cost of addressing its inequities. The consequence for reform was delay. Structural changes would come later, driven by repetition rather than revelation. In 1894, the opportunity to redefine market conduct in response to the crisis was present but unused. The hearings closed without altering disclosure standards, without naming informational advantage as a problem, and without challenging the private authority of those who controlled liquidity. What remained was a detailed record that stopped short of transformation. This outcome answered one question while raising another. It clarified why no one was punished, but not why no one attempted to change the rules immediately afterward. The answer lies in the distribution of risk. The costs of the crisis had already been absorbed by those least able to influence policy. The benefits of inaction accrued to those whose stability depended on continuity. Reform threatened inherited positions and institutional memory. In that balance, restraint prevailed. The silence that followed the hearings was not empty. It was filled with precedent. Market participants learned that even when questioned at the highest levels, their methods could survive intact so long as they remained within the letter of existing law. Institutions learned that inquiry did not necessarily lead to intervention. The system adjusted, not by correcting itself, but by confirming its boundaries. The bloc resolves its tension in this confirmation. In 1894, the public reaction reached its formal peak and receded without consequence. The Senate had looked, recorded, and moved on. What remained was not outrage, but a reinforced understanding of what the law would not touch. The image that closes this chapter is stark and administrative. A bound volume of hearing transcripts placed back on a shelf, its contents preserved, its implications deferred, while the market resumed under the same rules that had shaped the crisis, unchanged and now quietly validated. By 1896, the market no longer needed to improvise around advantage. What had once appeared as opportunistic behavior during moments of stress hardened into structure. The change was not announced, legislated, or even debated publicly. It emerged through integration. Corporate information and financial capital began to move as a single system, and once that integration settled into routine, unequal access stopped looking like abuse and started looking like competence. The clearest illustration of this structural alteration appears in the internal organization of Standard Oil during that year. By the mid-1890s, the trust had already consolidated control over production, transport, and pricing across vast segments of the oil industry. What changed in 1896 was not the scale of its assets, but the alignment of its internal reporting with external financial positioning. Operational knowledge, output levels, transportation constraints, refinery maintenance, contract renegotiations was no longer treated as information that would eventually reach the market. It was treated as capital itself. The action that defines this shift was administrative and deliberate. Internal reports were standardized, synchronized, and circulated upward through a narrow hierarchy that overlapped with financial decision-making. The same men who received advance operational summaries also sat in positions that influenced capital deployment, credit relationships, and security transactions tied to the trust's affiliates. Information did not leak outward, it was consolidated inward. This was not secrecy in the dramatic sense, it was reclassification. Operational data was formally internalized as proprietary, and access to it was limited by design. The consequence of that reclassification was immediate and durable. Markets began to anticipate Standard Oil's decisions before those decisions became visible in public filings or press coverage. Prices adjusted ahead of announcements, not because rumors circulated, But because those positioned closest to the internal flow acted first, the market, in effect, learned to read the shadow of corporate action through aligned financial behavior. What had once required guesswork became pattern recognition, but only for those already inside the network. This integration altered the rhythm of disclosure itself. Instead of information moving from corporation to market in a single outward motion, it moved in stages. First, it circulated internally among executives and aligned financial partners. Second, it expressed itself indirectly through capital movements, credit adjustments, accumulation or reduction of positions, changes in lending posture. Only later did it appear as a public statement, by which point prices had already incorporated the effect. The order of knowledge was reversed, and with it, the logic of participation. The legality of this structure was unassailable under the standards of the time. There was no obligation to disclose internal conditions on a fixed schedule. There was no prohibition against acting on knowledge generated within one's own enterprise. The trust form itself encouraged centralized control, and centralized control naturally produced centralized information. What changed in 1896 was not the existence of advantage, but its permanence. Advantage ceased to be episodic and became institutional. The risk of such integration was recognized, but quietly managed, concentrating information and capital within. The same channels meant that errors or misjudgments could propagate quickly. A misread internal signal could ripple outward through coordinated financial action, but that risk was acceptable to those in control because it was contained. Losses, when they occurred, would be absorbed within networks capable of enduring them. The public, receiving information last, would bear volatility without ever accessing its cause. The press adapted to this new normal with subtle shifts in language. Coverage increasingly treated large corporate moves as fate's accomplice, focusing on outcomes rather than processes. Analysts described anticipation and market expectations without interrogating how such expectations formed. The narrative assumed that sophisticated actors naturally understood conditions better. That assumption shielded the underlying structure from scrutiny because it framed inequality of access as inequality of skill. By 1896, the system had learned from its own excesses. The crises of earlier years had demonstrated the power of silence, delay, and coordination. Integration was the response. Instead of relying on ad hoc pools or improvised credit withdrawals, dominant firms embedded advantage directly into their organizational design. Information pathways were tightened, financial responses were aligned. What had once been a tactic became infrastructure. The social consequence of this alteration was subtle but profound. Markets increasingly rewarded proximity over participation. Success depended less on interpreting public signals and more on occupying positions where signals originated. This did not eliminate public investment, but it redefined its role. Public capital provided liquidity and legitimacy, while decision-making authority resided elsewhere. Inequality, already visible after the Panic of 1893, became normalized as a feature of efficient organization rather than a byproduct of crisis. The institutional consequence was continuity. Once integrated, the system no longer required overt coordination to function. Each component behaved according to its assigned role, and the overall effect was consistent. Information stayed inside until it had been monetized. Capital moved in advance of disclosure. Markets adjusted smoothly for those with access and abruptly for those without. The absence of scandal reinforced the belief that nothing improper was occurring. This normalization also explains the absence of immediate reform. By the time policymakers could have responded, The behavior in question no longer appeared exceptional. It was embedded in how leading enterprises operated. Challenging it would have required separating corporate governance from financial advantage, a move that threatened efficiency as it was then understood. Stability, not symmetry, remained the priority. The alteration of 1896 did not announce itself as a turning point, but it functioned as one. The market stopped reacting solely to events and began to move in anticipation of internal decisions that were never meant to be public at the moment they mattered. Advantage was no longer improvised. It was scheduled. The block resolves with a concrete image that captures this shift. A bound internal ledger dated 1896, its entries neatly aligned, marked confidential, showing operational figures on one page and corresponding capital adjustments on the next. The ledger is complete, orderly, and silent. What it represents is not a conspiracy, but a design, one that made unequal access routine, defensible, and increasingly invisible. And once such design exists, the next question is no longer how it works, but what disappears from the public record in order to keep it working. By the turn of the century, around 1900, the system no longer depended on dramatic interventions to protect itself. What had once required coordination, timing, and deliberate restraint could now be maintained through procedure. The center of gravity shifted away from markets and into records, not because records revealed too much, but because they could be made to reveal very little without ever appearing incomplete. At the New York County Clerk's Office, this shift took a form that was outwardly mundane. Documents continued to be filed, ledgers were maintained, indexes were updated. Nothing was burned, erased, or overtly destroyed. The action that mattered was technical. Records were archived in ways that satisfied administrative requirements while severing practical accessibility. Files were classified under categories that assumed prior knowledge. Cross-references were incomplete or non-intuitive. Retrieval depended on familiarity with internal conventions rather than on public logic. The result was not disappearance, but dilution. This method of concealment was particularly effective because it did not look like concealment at all. Anyone searching the archive could be told that the material existed somewhere. In theory, nothing was hidden. In practice, following a trail from one document to another required navigating filing systems that were never designed for external scrutiny. Names changed, corporate entities reorganized, trusts absorbed subsidiaries. What appeared in one index did not reliably correspond to what appeared in another. A record could be present and still unreachable. The danger of this approach in 1900 was subtle but significant. The market had already demonstrated that timing and access determined outcomes. If administrative memory became fragmented, accountability would follow the same pattern. Investigators, journalists, and reformers would encounter a paper trail that could not be assembled into a coherent narrative without extraordinary effort. Each individual document would appear legitimate. The absence would exist only between documents in the spaces where continuity should have been. The action taken by clerks was procedural, not ideological. Records were filed according to evolving standards, meant to manage volume, not to preserve clarity. As New York grew and legal filings multiplied, efficiency demanded compression. Older materials were moved, reclassified, or summarized. Indexes were simplified. In some cases, separate registers were maintained for internal use, while public-facing catalogs lagged behind. This was justified as modernization. The effect, however, was that earlier financial and corporate relationships became harder to trace precisely at the moment when their consequences were most relevant. The consequence of this fragmentation was institutional amnesia. Not total forgetting, but selective recall. Certain transactions could be reconstructed only with insider knowledge of where to look and how to interpret what was found. For the public, the past became opaque. Patterns that linked corporate decisions, market behavior, and administrative actions across decades dissolved into isolated facts. Without continuity, questions lost their force. An unexplained transfer in 1882, a delayed disclosure in 1890, a coordinated credit action in 1893, each could be acknowledged individually, while the system that connected them faded from view. This silence was not enforced through censorship. It was enforced through routine. Once a filing method becomes standard, it acquires legitimacy. Clerks follow it because it is the correct way to do their job. Institutions rely on it because it protects them from accusation without requiring denial. Silence becomes policy not by decree, but by repetition. What cannot be easily found cannot easily be questioned. The beneficiaries of this arrangement were those whose histories benefited from complexity. Large firms, established families, and enduring financial houses carried legacies that spanned reorganizations and name changes. Fragmented records shielded those legacies from linear scrutiny. To reconstruct a complete picture would require time, resources, and persistence beyond the reach of most critics. Meanwhile, the absence of clear evidence could be cited as proof that no systematic issue existed. The press, encountering these administrative barriers, adapted accordingly. Reporting shifted toward the present and the immediate. Historical continuity became rare, not because journalists lacked interest, but because verification was costly. Stories relied on statements and contemporary data rather than archival reconstruction. Over time, this reinforced a public understanding of the market as a series of events rather than as an evolving structure. Memory shortened, responsibility diffused. The risk embedded in this silence was cumulative. Each year that passed without a coherent record made future inquiry harder. Each reclassification, each summary, each procedural shortcut added another layer between cause and effect. If the full scope of past coordination were ever assembled, it would challenge not only specific actors, but the legitimacy of the administrative state that had preserved the records. That threat was never articulated, but it was understood. Silence protected more than reputations. It protected institutional authority itself. By the early 1900s, this approach had become normalized. No directive was needed. Clerks archived, researchers struggled, institutions continued. The truth was not denied. It was distributed so thinly that it lost shape. What remained was a collection of fragments that could be cited defensively, but not assembled accusatorily. This block resolves not with revelation, but with procedure doing its quiet work. The image that remains is concrete and unremarkable. A clerk's hand entering a reference number into a ledger, the corresponding file placed on a shelf accessible only by internal notation. The public index showing a partial entry with no clear path forward. Nothing illegal has occurred, nothing dramatic has been erased, and yet the record as a whole can no longer speak clearly. What follows from this is unavoidable. When silence is maintained through administration rather than secrecy, it becomes durable. And once durability replaces discretion, the past does not need to be defended. It simply becomes difficult to recover. The next question, then, is not what was hidden, but what remains visible today, and why those gaps persist despite a century of supposed transparency. In 1913, the country finally did what it had avoided for decades. It gave the game a name by building an institution designed to interrupt it. The creation of the Federal Reserve System was not a moral awakening, and it was not a sudden discovery of unfairness. It was an administrative response to repetition. The same pattern had appeared too many times, across too many balance sheets, and the cost of pretending it was merely conditions had become higher than the cost of defining it. By the early 20th century, the financial system had learned to survive its own shocks by relying on informal authority. Clearinghouses coordinated, private banks stabilized or withdrew credit. The press explained outcomes after the fact. Corporate information remained discretionary. Records existed, but they did not assemble themselves into accountability. This produced a structure that could function even efficiently as long as confidence could be restored quickly enough, and as long as the public accepted that volatility was the price of progress. The problem was that the mechanism of collapse was becoming predictable. Liquidity would tighten, call money would vanish, forced sales would follow, and the public would absorb losses while the same networks consolidated control. The sequence was no longer surprising. It was routine. The most dangerous feature of the old system was not that it allowed advantage, it was that it allowed a small circle to decide, quietly, when the market would be allowed to breathe. In earlier years, that decision could be framed as prudence. By 1913, it was increasingly seen as a systemic vulnerability. A market that depends on discretionary rescues and discretionary withdrawals is not merely volatile, it is governable by whoever controls the discretionary lever. The country had already seen what that meant in 1893, when short-term credit contracted and the market obeyed without any illegal act. What changed after years of repetition was not the ethics of the practice, but the perceived risk of letting it continue unstructured. The late naming of the problem can be traced through the language of crisis. When a panic occurred, it was described as a failure of confidence, a disturbance, a stringency in money. Those words were useful precisely because they avoided blame. They treated liquidity as weather rather than as policy. But the repetition forced a shift. The panic of 1907 in particular made the dependence on private coordination difficult to deny. It showed again that liquidity could disappear faster than the public could understand why. And that stabilization depended on a few institutions acting in concert. It also revealed something more delicate, that the boundary between stability and control was not firmly drawn. The same tools used to prevent collapse could also determine who survived it. The action that followed was not immediate punishment, because punishment still required laws that did not exist in the relevant form. The action was structural. Investigations and commissions accumulated, but the decisive move was institutional design. In 1913, the Federal Reserve System was created with the explicit purpose of providing formal mechanisms of liquidity and supervision, tools that had previously been exercised through informal networks and private discretion. This was not framed as an attack on old money, it was framed as modernization. Yet modernization in this case meant relocating authority from private rooms to a public framework that could be audited, standardized, and repeated without relying on personal reputation. The concrete change was simple in principle and profound in effect. The system would no longer be entirely dependent on the willingness of private houses to extend or withdraw credit at the critical moment. Reserve mechanisms could be organized. Liquidity could be supplied through formal channels. Supervisory expectations could be established. The goal was not to eliminate asymmetry of information. Corporate disclosure would remain uneven for years, but to reduce the power of timed liquidity withdrawal as a market command. The creation of a formal lender of last resort architecture signaled that liquidity was no longer to be treated as a private commodity whose availability could be altered without consequence to the broader system. This is why the narrative of 1913 is best understood as a belated boundary-drawing exercise. For decades, the system had tolerated practices that moved markets without lies, delayed announcements, coordinated pools, selective access, credit tightening that functioned as a trigger. Those practices were survivable as long as the public accepted that the market's rules were unwritten and that the cost of participation included blind exposure to timing. But repeated crises transformed those practices from a private advantage into a public risk. The country did not decide that the conduct was newly immoral. It decided that the conduct was too powerful to remain informal. The consequence for the Gilded Age model was real, even if it was not immediate. The older environment had been defined by discretion. Information moved through social and institutional proximity. Liquidity moved through private agreements. Archives were technically intact, but practically fragmented. The Federal Reserve's creation did not erase those realities overnight, but it altered the center of gravity. It introduced a formal structure capable of contesting the private timing advantage that had defined earlier crises. It also created a new language for describing what had previously been dismissed as mere conditions. When supervision exists, absence becomes visible. When a formal liquidity framework exists, discretionary withdrawal looks less like weather and more like policy. This is where the delayed naming becomes unavoidable. The practice only became a problem once it repeated enough times to threaten the system's continuity. That is not cynicism. It is institutional logic. Societies rarely regulate what benefits their most powerful networks. Until the same behavior begins to generate costs those networks cannot reliably contain. The Gilded Age model produced immense expansion. It also produced predictable points of failure. By 1913, those failures were no longer isolated shocks. They were a pattern that exposed the system's dependence on private control. The change also carried an implicit admission, even if it was not stated as such. A market cannot claim neutrality if its survival depends on a private circle deciding when liquidity will be available. A republic cannot tolerate repeated collapses if each collapse consolidates wealth upward through mechanisms the public cannot see or challenge. The Federal Reserve System was not designed to equalize outcomes. It was designed to reduce the frequency and severity of collapses driven by credit stringency, and, by doing so, to reduce the recurring opportunity for the same consolidation to occur under the cover of legality and urgency. Yet even here, the old logic did not disappear. It adapted. Formal liquidity and supervision narrowed the space for certain Gilded Age maneuvers, but they did not erase the deeper asymmetry. Access to information, proximity to decision-making, and the administrative capacity to shape what becomes knowable and when. The system was being renamed, not purified. The rulebook was being written, not made complete. And that matters, because it explains why the story does not end with 1913. It turns. This block resolves. One tension clearly. The informal model of the era dorada did not collapse under moral condemnation. It was displaced because repetition turned private advantage into systemic risk. The country built a formal framework to stabilize liquidity and supervise the mechanisms that had previously operated through discretion. The unresolved tension, prepared for the final topic, is narrower and sharper. Even after the game acquired an institution and a vocabulary, which parts of the old system remained unnameable, and which gaps in the record, still fragmented by procedure, prevented a full accounting of how the earlier fortunes moved. The closing image is concrete and administrative. December 1913, a signed act in final form on a desk, ink drying as clerks stamp copies for distribution, while elsewhere older ledgers and cross-references remain on shelves, intact but incomplete. reminding us that formal oversight begins with law, but truth still depends on what the record allows to be found. In the months that followed 1913, the shift was measurable not in speeches, but in plumbing. The Federal Reserve System did not change who owned information, but it changed who could survive without it. That distinction matters because it moves the focal point of control away from purely private coordination and into a framework where liquidity could be supplied by design rather than by favor. The first practical alteration was the creation of a repeatable discount mechanism. When a bank faced an abrupt shortage, it no longer had to rely exclusively on the mood of correspondence or on informal clearinghouse arrangements. Eligible paper could be rediscounted, and the cost of funds became an administered variable rather than a purely social one. In a market where call money had functioned as a silent weapon, a formal backstop did something narrow but decisive. It reduced the speed at which solvency could be converted into forced liquidation. That did not prevent losses, but it disrupted the timetable that had previously allowed insiders to profit from a predictable sequence of credit withdrawal and compelled selling. The second alteration was supervision as a discipline rather than a scandal. The old regime had depended on fragmentation. Each institution could defend its actions as isolated prudence. A system that begins to examine reserve positions, exposure, and funding practices changes the incentives even when it lacks modern enforcement concepts. Banks could still tighten credit. They could still protect themselves, but coordinated tightening became harder to present as purely coincidental once the system began to track patterns across institutions. The difference was not public outrage, it was internal visibility. Visibility changes behavior even when it produces no prosecutions. A third change, less obvious but more durable, was standardization of expectations. The Gilded Age market operated on irregular calendars, announcements when convenient, disclosures when unavoidable, liquidity when offered. Formal mechanisms introduce routines, reporting cycles, eligibility criteria, reserve requirements, and a shared vocabulary for conditions. That vocabulary is not neutral. It narrows the space in which a private actor can claim that a systemic event is merely accidental. Once the system recognizes a category, stringency, discounting, reserves, it becomes harder to pretend that the category does not exist. Yet the most important consequence was social rather than technical. By reducing the likelihood that a single day of credit withdrawal would become an immediate sentence, the system altered who could remain in the market long enough to see recovery. In earlier crises, the late entrant lost not only because prices fell, but because time was taken away. The new framework did not guarantee fairness, but it reduced the frequency with which time could be confiscated overnight. This is the quiet meaning of a lender of last resort. Architecture. It protects duration. Duration is the difference between a loss and a forced loss. There were limits, and they were not accidental. The Federal Reserve System did not impose comprehensive corporate disclosure. It did not define privileged information as contraband. It did not erase the private networks through which operational knowledge moved. In that sense, the game did not end, it adjusted. The most refined advantage shifted further toward interpretation and position, rather than toward brute control of liquidity. When liquidity is less easily weaponized, informational asymmetry gains relative weight. The market's vulnerability changes shape. It becomes less about sudden freezing and more about quiet anticipation. This is where the late naming becomes sharper. The country built a structure to stabilize money, not to litigate the past. Formal mechanisms were created to prevent recurrence, not to reconstruct who benefited in earlier cycles. That choice had an institutional Logic: the moment you attempt to assign retroactive responsibility, you threaten the legitimacy of the very networks needed to stabilize the present. The system, therefore, moved forward with a new architecture, while leaving older movements of capital largely unexamined in a prosecutorial sense. The record remained intact in fragments, but the political incentive was to build a dam, not to revisit every flood. The result is a paradox that defines the post-1913 environment. Liquidity became more formal, yet the deepest advantages remained informal. Oversight increased, yet memory stayed incomplete. The market could be stabilized without being fully explained. That is why the Federal Reserve's creation reads less like a moral conclusion and more like an administrative turning point. It reduced the bluntest lever of control while preserving the structural conditions that had made control profitable in the first place. The extension resolves with a concrete, non-symbolic image. An early circular distributed to member banks outlining discount procedures and eligibility, filed neatly in a binder, while in a separate archive, older corporate correspondence and clerk indexes remain cross-referenced in ways that still require the right person to know where to begin. The system learned to interrupt the panic, but it did not learn, at least not immediately, to make the past easy to prove. By the time the new century learned to speak the language of oversight, the older century had already written its habits into stone. In 1890, the market could be guided by what was not said, by what was delayed, by what remained inside rooms that never needed to sign their decisions. In the 21st century, Wall Street speaks more openly, files more regularly, and carries statutes that did not exist when railroads and trusts first proved what timing could do. Yet the underlying fact has not vanished. Advantage still begins where information travels first. It is simply contained now, framed, regulated, named only after it had already proven indispensable. This is the legacy that still operates. Legality has always been the shape of the corridor, not the character of the men who walk it. The Gilded Age did not invent the impulse to know before others. It merely exposed what happens when a system is built without insisting that knowledge arrive evenly. Fortunes changed hands without a broken contract because the law had not yet learned to define the transfer as a crime. And when the law finally arrived, it did not erase the earlier architecture. It refined it, adding railings, posting notices, drawing lines, while leaving the oldest passages intact for those who already knew the route. Consider the comparison as it stands. 1890 and the modern era are separated by regulation, but joined by sequence. The order still matters. Who learns first? Who can wait longest? Who can act without needing permission from the public mood? Today, the advantage is more carefully described, audited, and punished when it crosses the written line. But the written line itself is a late invention, and the market remains an institution that rewards proximity to decisions, not merely participation in outcomes. The moral vocabulary follows the statute. It rarely precedes it. That is why the most durable manipulations are not the ones that shout. They are the ones that fit cleanly inside what the era allows. If this sounds familiar, it should. The record has been telling the same story for more than a century, though it rarely tells it in a single place. It appears in the timing of disclosures, in the choreography of liquidity, in the quiet relief of those who exit before the corridor narrows. It appears in court language that defines what can be prosecuted, and in institutional language that defines what can be forgotten. When markets are said to be fair, they mean fair within the rules that exist. The more important question is always who shaped those rules, and how long they were allowed to operate before anyone demanded that the rules be written at all. And so we end where this investigation began, not with a scandal, but with an archive. The truth of the older game was permitted to survive only in paper. Ledgers, indexes, circulars, transcripts, stored in rooms that outlast outrage. The doors close softly in such places. A clerk's lamp is lowered. A file is returned to its shelf with a number that means nothing to anyone who does not already understand. The system that produced it. The corridors remain polished by time, and the silence never needs to defend itself. It only needs to persist. Leave your thoughts below. Every perspective helps illuminate what history tried to bury. If this story resonated with you, let us know. It tells the algorithm these forgotten halls are worth exploring again. And subscribe quietly so that you're here when the next sealed door finally opens. Because if you are willing to step deeper into the shadows, the next chamber already waits. Some secrets survive only because those who feared them left no one to tell the truth.